At its peak, a single California insurer held more assets than most American banks. $13 billion policies for 350,000 families, and a portfolio so large it anchored the entire junk bond market. Then, in a single spring, it was gone. In 1974, a Wall Street contrarian named Fred Carr took control of a sleepy Los Angeles life insurance company with an idea Wall Street called reckless. He would turn boring insurance money into the highest-yielding portfolio in America. That gamble built the fastest-growing life insurer in the country. But within 17 years, policy shifts, a criminal indictment, and a secret French buyout reduced all that capital to ruins. What forces could destroy California's #1 life insurer, and what really happened inside Executive Life Insurance Company? $13 billion. That is the number stamped into America's insurance memory by a single company based in Los Angeles, California. For nearly 2 decades, Executive Life wrote more policies than most rivals and held more assets than any life insurer on the West Coast. 1 out of every 4 high-yield bonds issued in America sat on its balance sheet. At its peak, the company served more than 350,000 policyholders, from retired teachers in Fresno to accident victims in San Diego, collecting structured settlements. Over 1,200 employees kept its Los Angeles operation humming, writing more than $1 million in new policies every single day. Executive Life's reach was not just regional. Its bonds funded leveraged buyouts from Wall Street to Texas, and its premiums flowed in from all 50 states. By 1989, its financial statements showed more than $10 billion in junk bonds alone, more than any other insurer in the United States. The company's scale was unmatched, its growth legendary. These numbers are not just statistics. They are the measure of a state's confidence, a workforce's pride, and a brand that once promised security to hundreds of thousands of American families. The story of how Executive Life reached such heights begins with a single man and a single bet. If Wall Street could mint fortunes from risky debt, California could build an insurance empire on the same foundation. In 1974, Fred Carr acquired First Executive Corporation, the parent of Executive Life. Carr had been a mutual fund star in the 1960s, then a Wall Street outcast after his enterprise fund collapsed in the bear market of 1970. He needed a second act, and insurance offered him one. Regulators required life insurers to hold reserves against future claims, and those reserves traditionally sat in safe government bonds, earning modest returns. Carr saw a loophole. If he invested those reserves in high-yield corporate debt, known on Wall Street as junk bonds, he could offer policyholders double the returns of his competitors. The higher the yield, the more policies he could sell. The more policies he sold, the more capital he could pour into bonds. By 1978, Carr had found his partner in this strategy. His name was Michael Milken, the head of high-yield bond trading at Drexel Burnham Lambert. Milken was reshaping American corporate finance, funding hostile takeovers and leveraged buyouts with bonds rated below investment grade. Executive Life became Milken's largest single customer. In return, Milken steered the most lucrative issuances toward Carr's company. The relationship was so close that some analysts called Executive Life the insurance arm of Drexel Burnham. Between 1982 and 1988, Executive Life's assets grew from $3 billion to over $18 billion. Carr appeared on magazine covers. Trade publications named him Insurance Executive of the Decade. The strategy seemed flawless. As long as the junk bond market held, Executive Life could outgrow every competitor in the state. Policyholders, lured by annuity rates 2 full points above the industry average, poured their retirement savings into Executive Life contracts, many of them elderly Californians seeking a safe place to park a lifetime of work. The warning signs, however, were already visible. In 1987, the Securities and Exchange Commission opened an investigation into Milken's trading practices. In March 1989, a federal grand jury indicted Milken on 98 counts of racketeering and securities fraud. Drexel Burnham Lambert settled with the government for $650 million that same year, and in February 1990, the firm that had built the junk bond market filed for bankruptcy protection. Milken himself pleaded guilty to 6 felony counts in April 1990 and was sentenced to 10 years in federal prison. For Executive Life, the collapse was catastrophic. With Drexel gone, there was no market maker for high-yield bonds. Prices plunged. Between early 1990 and the end of that year, Executive Life's junk bond portfolio lost an estimated $4 billion in value. State insurance regulators across the country began demanding disclosures. In California, new rules force Executive Life to mark its bonds to market for the first time. When policyholders read the headlines, they panicked. Between late 1990 and early 1991, policyholders withdrew more than $3 billion from the company. A classic run on the bank played out in insurance form. Carr resigned in January 1991. Ratings agencies slashed the company's grade to junk status within weeks. The institution that had once sold itself as a haven of security was now the most dangerous name on the West Coast. By the spring of 1991, Executive Life was insolvent. On April 11, 1991, California Insurance Commissioner John Garamendi seized the company. It was the largest life insurance failure in American history. More than 350,000 policyholders woke up to find their policies frozen, their annuity checks suspended, and their retirement savings locked inside a collapsed institution. Elderly Californians who had paid premiums for decades, accident victims living on structured settlements, widows drawing survivor annuities, all of them saw their payments cut overnight. One widow in Pasadena told the Los Angeles Times she had lost her husband, her income, and her faith in paper promises all in the same month. Then came the second scandal. As regulators sold off the bankrupt portfolio, a French state-owned bank called Crédit Lyonnais quietly assembled a bid through a web of shell companies. Under federal law, a foreign government-owned bank could not own a United States insurer, and the shell structures were designed to hide that violation. In 1992, the portfolio was sold to a group called Altus Finance for roughly $3.25 billion. Only later did federal investigators discover that Altus was a front for Crédit Lyonnais and its allied holding company, Artemis. Billionaire François Pinault, the owner of Artemis, acquired the insurance policies through the same structure, reaping billions in profits as the junk bond market recovered. In 2003 and 2004, Crédit Lyonnais Artemis and their partners agreed to pay more than $771 million in fines and settlements to the United States government, one of the largest corporate penalties of that era. For policyholders, the damage had already been done. When the reorganized successor company, Aurora National Life, finally began paying claims, most policyholders received approximately 70 cents on every dollar they had been promised. Retirees who had counted on a specific annuity check for life received a permanently reduced amount. Structured settlement victims, many of them severely disabled, lost a significant portion of their court-awarded compensation. Investigative journalists at the Los Angeles Times documented case after case of elderly Californians forced back into the workforce, losing homes, and rationing medications. The warning signs were clear, but the damage was done. 3 lessons. Yield is not safety. Fred Carr sold policies on the promise of superior returns, but those returns were built on a single, fragile market. And when that market broke, so did every promise attached to it. Regulation written for one era cannot police the next. State insurance law in 1974 was designed to protect reserves held in government bonds, not reserves held in high-yield corporate debt. By the time regulators understood the risk, $13 billion was already exposed. And finally, a single partnership can become a single point of failure. Executive Life did not merely invest with Michael Milken, it depended on him. When his empire fell, Carr's empire had nowhere to stand. These are not just warnings for a vanished insurer, but for any institution that wagers its future on the promise of endless yield. Fortunes vanish, but their lessons linger. Today, the junk bond market Fred Carr and Michael Milken helped create is worth $1.5 trillion, proof that no regulatory reform has ended America's appetite for yield. The Executive Life collapse remains the largest life insurance failure in the nation's history, a reminder that even institutions built on the language of permanence can evaporate in a single season. Our financial future is not set by promises printed on a policy. It is decided by every risk a trusted institution chooses to take. What do you think is next for American finance? Share your perspective below.